Here we are today. A few technical difficulties before I started, but we did get started on time, so that is good. And this is going to be the first session I have of two for year-end tax planning. The year-end tax planning issues we're going to be discussing today are going to be 199A issues. We're going to talk about some entity issues. We're going to talk about people who have rental properties, income properties. We're going to talk about some charitable strategies. The things that we're going to talk about here are going to have a lot of screen shares, and if it works, fingers crossed, because I got the program set up for it, I should be able to share some of my screens so I can show you some of the things you're going to expect to see. So if you're a tax professional, you can use some of this information to build some policies in your office. And if you're not a tax professional and you're a do-it-yourselfer, then you're going to want to be paying attention to some of these screenshots as well, because it's going to show you some of the things you're going to need to do. So as we get started here, I think we should get a few people signing on pretty good here. So just one second. So we're going to show some of this here. So there we go. And hopefully everybody can see that. We'll get a couple people coming in right away here. So, excuse me. This is a two-part session. So we're going to have a part today. I did this here Central Time, 10 o'clock in the morning. So more tax professionals and their office staff would come in and watch and look at some of the policies and procedures I'm going to have. And then next week, Wednesday, that is going to be on the, is it Tuesday? On Tuesday the 18th at 8 o'clock at night Central Time, I'm going to be dealing with also some very important personal tax return issues. Today, we're going to talk about things like if you have a rental property, if you have a small business, do you get any K-1s, like is there an S-Corp or a partnership? If you have charitable issues that, for contribution to charity that you'd like to discuss, we can do that. And that'll probably fill our topic today. Lots of links, lots of screen shares for you guys so that you can use these things in your own planning and strategizing, because otherwise I can't do it all here right away. But these links will be put in the description at the end of this. I will get a bite to eat when I'm done with this in an hour or so. Then I will add these links so you can actually link on this, so you can actually do your own calculations for your own return, so you can do some quick year-end tax planning. And if you need to modify the numbers a little bit, it would be really, really nice to have that tool, and that's what it's going to be. If you're interested in some additional topics, we're going to have deductions people miss, trying to keep your adjusted gross income lower for people with maybe the healthcare.gov issues, or they want to maybe phase into something like if you have the earned income credit or something. Property tax issues, those salt taxes, high tax state people, asset allocation for real estate, and capital gains taxes. You can avoid those. That'll be actually next Wednesday's discussion. If somebody has questions today, we can touch on those. And I haven't set this one up yet, but I'm going to be doing a video on audit proofing your tax return in January. And I do thousands of returns, and of these thousands of returns, we go sometimes years without a audit. And I'm going to have a course on that, where whether you're a professional or doing your own return, I'm going to show you how to prevent these types of problems from cropping up, because you just don't want to have any of these audit issues. So we have a few people here. So I'm going to start with a few of the issues that I wanted to put in. I'm going to have screenshots, which are going to show you some of my tax program. And yes, your online program, your program might be different, but it's going to look very similar. The other thing I'm going to show is a couple screenshots, hopefully, that work. And in fact, I'm going to start playing with some of this a little bit here, and things that I think are going to make a difference. In fact, one I think you guys are going to really like. And let me see if I can go ahead and get that. So I think you can actually see that on the side there. We're going to go into that a little bit later. So I'm happy that we can get a couple of these things connected together. So if you have any questions along the way, you can add them as we go. So let's get right into it. The first thing I wanted to talk about is this entities, which is going to be, should I have an LLC? Should I not have an LLC? And I've had a lot of problems with people coming in from my blog in the last couple weeks. So I've had to do a lot of research, and I had to go to attorneys and try to fix some problems. In some cases, I couldn't fix the problems. And so I'm going to talk about the advantages of having an S corporation, the advantages of having an LLC, what you should put in these entities, what you should not be doing, and those are very important considerations. Actually, one other housekeeping item I want to touch on. I want to read you a paragraph. I had I had a tax insight course. This is continuing education here for accountants, and it gives me CPE credits. There's actually a paragraph in here which just blows my mind, and it's very important, I think, for people to understand this because well, let me just read it and give you my comment. It's called employee training. The IRS has reduced its employee training budget by nearly 75% since 2009. In 2017, the IRS spent $489 per employee on training. That's less than what I pay for myself and my employees, compared with nearly $1,450 per employee in 2009. Again, I spend much more than that per employee in my firm. In addition, the way in which employees receive the training, that training has shifted from face-to-face training to virtual training. We do both of those in my office, by the way, virtual as well as face-to-face. The NTA notes that if the IRS is unable to provide adequate training to its employees, taxpayers cannot expect to receive quality and accurate service, which will potentially cause additional costs to the IRS, unquote. Here's the issue. Just because the IRS sends you a letter or an auditor tells you that you did something wrong, because of their lack of training in many cases, unfortunately, the sad truth is they are not always correct. That's why this training course is important, and it's important that I get you some of these nuances because, if they're not going to spend insatiable amounts of time doing the things necessary to get really good, let me get rid of this for right now. If you're not going to do the things to get really good, the IRS is going to be making some mistakes, and you need to arm yourself with the correct answer. So if you're a do-it-yourself or if you're an accountant, no problem, if there's an audit or some kind of IRS question, but you need to be the tax professional in the room because, as we see, the IRS is not necessarily going to be that tax professional. So now let's move on to LLCs, corporations, S-corps, things like that. We're not going to talk about the tax involved with that, but who should do it and when. So a couple of situations. You can have a side gig, you can have a small business, you might have a farm or a small farm, you might have some rental properties. If you read a blog post, and I'll put it in the link at the end, I have a blog post way back in the beginning when I started talking to people about how to set up a small business and save a lot of money with an S corporation. If you're a side gig or if you have a small business, the answer for most people is you want to organize as an LLC, and then you make an election to be treated as an S corporation. If you make $30,000 or less, that doesn't work real well. And in fact, once you get to about $50,000, it's a little bit easier. Between 30 and 50, it kind of works sometimes. But what happens is this: when you're self-employed, you earn income. So let's say you have $100,000 of revenue and you have $50,000 of expenses. You got a $50,000 profit. As a sole proprietor, you're going to pay self-employment tax on the whole thing, on the whole $50,000. So you're going to pay 15.3%, about $7,500. Now, if you become an LLC and don't do anything, you're what's called disregarded. So you still end up being a Schedule C. You still pay the taxes the same way as a sole proprietor, but you do have this legal umbrella around you, or this shell, if you will, that protects you from a legal standpoint. Now, if you elect in a situation like that to be an S corporation, you then need to pay yourself a reasonable compensation, a reasonable wage. So there's kind of some rules of thumb that are not necessarily codified, but the things that a lot of accountants use. There's a 60-40 rule, which I don't think is real accurate all the time. I don't use it, but it is a starting point. And that is, you need to have some reasonable wage in your small business. So you got a small business, $100,000 of revenue, $50,000 profit. You're going to pay yourself, let's say, $30,000. So you pay yourself a W-2 wage of $30,000. There's $20,000 left in your S corp. It's going to flow right through to your personal tax return on a K-1, and that $20,000 will not face self-employment tax at 15.3%. It's about a $3,000 tax savings, and that's the easiest way to make money with an S corporation. And like I said, the link will be there so you can go deeper into that. But where else can you use an LLC and save some money, save some time, maybe create a better situation for yourself financially? And I see this with real estate, okay? And this is, and again, it happened twice in the last couple of weeks, so it's very bothersome. You never, ever, 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 ever put real estate inside of an S corporation, and that includes an LLC treated as an S corporation. So let's say you have a business like mine. You have my tax business and you have an office building, which I own. I'm going to stand back here. So over here, I have my tax business, and it's going to be Tax Prep and Accounting Services Incorporated. This is an S corporation. Over here, this is my building owned by me. It has an LLC, but it's going to be disregarded, just goes on Schedule E. This company, Tax Prep and Accounting Services, pays this owner, me, rent for that building. Now, why is that? Well, first of all, we want to segregate the two because there's things like personal holding corporations, but mostly where you run into a problem is if you have, well, how can I explain this? Let me explain the worst part. If you are ever a regular corporation and have accumulated earnings, which you almost certainly do, and you then become an S corporation, if you have more than 25% of your income from passive sources such as rents, dividends, interest, that kind of stuff, you will, after 3 years, be having your S election revoked. Now, why is that a problem? Well, if it's revoked, that means technically you go from an entity, the S corporation, to a disregarded entity for taxes. That means that this property over here, it's as if you sold it to yourself and you got to pay capital gains tax on that money. What is the solution? Well, there is no solution once you put the money in there or the real estate inside an LLC. The LLC is okay to put the real estate in, but you never turn it into an S corp because as soon as you turn it into a corporation, you've created a real problem. So if you've already done it and there's no accumulated earnings, there's nothing you can do to fix it. You either change it and pay the capital gains tax when you really haven't even sold it, or you just live with the consequences and hope for the best. And that's the way it goes. LLCs with real estate also have a unique animal that I think is more valuable. So keep in mind what an LLC does. Here's this LLC. It's a wrapper. There's no tax return or tax form for LLCs. You have to choose how you want to be taxed. It is okay to look at an LLC and say it's a legal document because that's what it is. You get this legal document. You can go ahead and do all these things. In fact, let me kind of do some things here. I'm going to change some goodies. And what happens is you can manage better. So it's okay to have a disregarded entity with an LLC because the idea is legal protection. And as a bonus, we might get some tax advantages. So you have real estate. How many LLCs do you want? So I have somebody will come in and they'll say, well, if I got 50 rental properties, do I need to have 50 LLCs? Some people do that. I don't think that's quite right. But if you say I got 50 properties, more than one property, 4, 5, 6, 7, 8 rental properties, do you want to put all your properties into one LLC? Well, keep in mind, an LLC is this wrapper, like a firewall around whatever the assets inside this LLC is. So if you have an LLC and you have a rental property in this thing, and a tenant falls down and slips on the sidewalk and sues you for $1 million, the risk to you from a legal standpoint is contained within this LLC. The LLC is going to have this firewall between all your other stuff and other LLCs and this. So they might be able to take that house. Maybe the insurance isn't enough. Maybe something happened that is going to cause a problem, but you have one building at risk. Now, some people say, well, then I'm going to put all 50 of my rental properties in there. But if one property gets sued, all the properties are liable. Here's a better answer, I think. I like to have clients, and when they have multiple properties, we have 2, 3, 4, maybe maximum, depending on the facts and circumstances, properties in one LLC. So it's very common for me to have a client come in and they'll say, I own 8 properties and I own 2 in Kansas and 2 in Georgia and 2 in California and then 1 in Texas and 1 in Wisconsin. I'll take the Wisconsin and Texas one, move them together, and I'll have 4 LLCs versus 8. It saves you annual fees with the LLCs, okay, because there's annual fees there. And so you certainly have an advantage of liability protection, but you don't necessarily have to spend $5,000 a year to keep all these LLCs running. So that's the first thing. So those are LLC issues and entity issues. Really brief discussion on that. The other thing I want to bring up is that for 20, 30 years, I did not have hardly any C corporations, or what are called regular corporations, as clients, because normally it wasn't that advantageous. Now we have to sit back and ask the question, is it advantageous to have a regular corporation for your side gig, or for your or for your S corporation? And the answer, unfortunately, isn't that easy, because the tax bracket now has gone from a graduated scale for a C corporation. And what that is it used to start at 15% and then went up from there. Now it's capped at 21%. It's 21% basically from $1 to $N. If you're under $50,000, the old rules were actually better. Actually, the tax rate went up for the first $50,000 with an S or with a C corporation. The answer, though, is for people that have extraordinarily high levels of income, there are cases where a regular corporation still makes sense. However, I currently have a client that has a C corporation, and we're going to go to an S, and that creates a lot of problems, but we can do it. The savings on this is going to be incredible, actually, for the client. So I'm going to do it. But it's not something that you automatically discount the C corporation anymore. So if anybody has any questions with their real estate, side gig, small business, how this would work, they will show up in the list there for me, and I can answer those. We can come back to them as well. Now, the next thing I'm going to go into is I'm going to go into two different things with what's called Section 199A. This is big in the news, and anybody that has, again, a small business, rental properties, and any kind of, in fact, some investments like REITs, things like that are going to make a difference. So if you have a master limited partnership, I'm wondering how some of that's even going to play through. And then we're going to finish up with some tax strategies for charitable giving. But this 199A is big. And the calculations with this is extraordinarily complex. And it's always easy to say, well, wait until tax time, play with the tax software, and then you're all happy, right? Well, that's not necessarily a good plan, because what you do today will make a difference on your tax return in a few months. So I'm going to bring this back up here if I can, and I'm going to start with this because I think this is worth doing. In fact, I'm going to there we go. So what people sometimes have problems with this 199A and the complexities is people think that there's a phase out. There is not a phase out, there's a phase in. And that's a significant difference. So for people that are joint filers, 315,000 or less, we're all golden. We all love that. It's no big deal. Easy for me to prepare it, easy for me to run the numbers. It's basically 20% is the deduction. Pretty straightforward for side gigs, small businesses, S corporations, things like that. Regular corporations do not get this. There is also different rules for rentals, so we're going to talk about that in a second. So The 199A for a small business, when you're under $315,000, it's easy to do, but between $315,000 for a joint return up to $415,000, you have this phase in zone. In the phase in zone, you start calculating using wages. So there's a long formula for this that includes wages, but wages don't really matter. The other problem that comes in, certain people are going to be excluded no matter what once they hit the phase out or the phase in. So it hits $315,000. So here's the people that are excluded. And this is, by the way, really muddy. The ones we know are excluded, and we're going to go into this in a second. I'm going to show you actually an example that my tax software gave me, which is kind of neat because it's actually up longer, but it's not me. It's just a fake one that's sent. It's a test return for the IRS to make sure my system's working. But let's do this. Let me do this. So I'm going to set this up here. at the same time you're side by side. So if you can look at this and you see in the top up here, the guy's making $100,000 and he has a bunch of expenses. If this was much higher, so let's say this guy is married, filing a joint return, let's say it's $350,000, we're going to have some phase in. This guy is not going to see a full 20% QBI deduction. He's going to see a pro rata portion. This is one of the things you're going to have to focus on in the return. The second thing, what I'm going to show you is we're just going to go to a view screen here. I'm going to actually get rid of my Okay, are we getting audio now? I didn't see the comments coming through. It was scrolling down. Okay, I'm sorry about that, guys. I am sorry about that. I didn't realize that. I said I'm brand new at this. You still can't hear anything? Can you hear? Can somebody hear something now? Can somebody sound? Yes, okay. I got to keep both of them up. Okay, so we're going to keep two screens. I'm sorry about that, guys. I really apologize. So I talked for a few minutes and didn't even see all of that. So, okay, let me do this. I don't know what parts you missed. I'm glad that you guys are hearing me. I'm gonna give a quick synopsis. Okay, the tax software is going to cover most of this for you for the most part. It's going to be fairly easy, as long as you check all the boxes correctly where they need to be checked. So let's go back into the actual program. So hopefully this is easy to see on your screen because I know it's dual screen. I have to do this in like a talk show mode to get these share screens. So that's why it's important. Let's go back to here again. We're gonna, if you can see my mouse in the lower right-hand corner of this screen, this is gonna probably be very similar to what you're gonna see in Tax Cut, TurboTax, and all the tax software for the professionals are gonna look like this. You're gonna see this little box in the bottom there saying specified service industry. That is gonna be remarkably important for most of you guys. So let me go ahead and pull this back up again. If you hit, in my case, it's Alt question mark. If I do that, it's going to give me a cheat sheet, so I don't have to necessarily be looking back into all my books and this kind of thing. Okay, so it's on the full screen audio. Well, you know, we're just going to have to keep the split screen then. That's just the way it is. You know what it is? I think it's when I have it in the first box. Oh, you know what? I see what it is. Here we go. It's because I get what I'm doing here. Excellent. If make sure you yell loud at me if it goes out again. I said this is brand new for me, this new program I'm using, and I'm sharing screens for the first time. This $199 cheat sheet should be available in most of the software that's over the counter. If you use if you go to my website and use my program, which I like because it's good for me, you can use my professional grade software, same software I'm using in my office to prepare your own return. These cheat sheets will pop up for you online as well. This will tell you the things that are and are not. These financial services, brokerage services, things like that, some of these things are going to be modified in the future. But as it stands right now, that's what we see. The important part is to check the box on that. Now, I'm going to jump between businesses, S corporations, and properties, rental properties, because those three, there's a lot of similarity. And I want to make sure that you guys don't miss any of these elections, because especially the do-it-yourselfers, this is going to be a problem. When it comes to rentals, I want you to consider the policy in my office to be the policy in your tax office, or if you're doing your own return, to be your policy on your personal return, because you only have one. So what you're seeing here, excuse me, so what you're seeing here on the left-hand side of your screen is my screen for my program if you have a rental property. This is going to be a little different because rental property is not a specified service industry. So by all intents and purposes, it should count for pretty much everybody, but not so fast. If you see down in my bottom right-hand corner again, they got a nice little box down here, and it's going to say qualified business income deduction. There's a box there that's going to say yes or no. Now, it says this activity is a trade or business. Now, why is this important? There has been no guidance from the IRS on what they mean by a trade or business. There is no place in the tax code that actually clarifies what or defines what a trade or business is. You actually have to go to the tax court and look up tax rulings to see what the tax court thinks. The tax court tells us what they think a trade or business is. So if something is a trade or business in rentals, well, I've always taken the approach that if I got a rental property, one building, and I'm renting it out X amount of dollars per month, get $10,000 of rent per year, my argument is that's a trade or business, and I'm hanging my hat on the connection that if I had a small side gig and made $10,000, I would want to be deducting the if I had a $10,000 side gig, I'd be putting on Schedule C and paying self-employment tax. It's a trade or business on one hand, it's a trade or business on the other hand. But that's not a very satisfying answer. It's just me making this allegory, if you will, connecting the two dots. It's not something that is actually that I can point to tax code and say I'm using that as my guide. When I was at Tax Insight, I heard the most intelligent answer to this problem from the beginning, and that is this. If you have a rental property, something on Schedule E, and you sell the property, where does the sale go? Does it go to Form 4797, which is going to be, well, this is not going to look real good on my screen here. My 4797s look like this. When I sell a property, I'm going to have something like a depreciation screen. It's going to be all filled in here. This bottom right-hand corner, I fill in the sales information. It's going to carry it right to where I want it to go. If you have a rental property, it is almost certainly going to go to Form 4797. That means that it is a trade or business. If you have, on the other hand, you see right here in this box above the qualified business income box down here, you see this is a taxpayer's main home or second home. So in Wisconsin here, we do, a lot of people buy a cottage up north. They will maybe buy a second home up north. Sometimes they buy some hunting land. Now, the question mark then is that qualified business income? That would be a trade or business. So they have some hunting land, they rent it out once in a while. They have a second, or they have a cottage up north, they rent it out once in a while. And the answer is that's generally being held as an investment. And therefore, it might show up on Schedule E because it's rental income, but it's going to, when you sell it, it's going to end up on Schedule D as a capital gain or a capital loss. You can't have a capital loss on personal property, by the way, but capital gains would go on Schedule D. And that would not be a trade or business, and therefore, you would not get the deduction. So a little back of the envelope calculation here, what we're going to do. For a small business, you have a side gig, and most people listening to this are going to fall below those limits regardless of what business they're in. So let's say, if you have a side gig, maybe you want to do taxes on the side a little bit like I'm doing. You watch my blog and, hey, this is a great side gig. Work a couple months of the year, you got her made, make zillions of dollars, and that's it, right? So let's say you make $50,000. $50,000, it doesn't matter. You have, let's say, $100,000 in revenue, $50,000 in expenses in your side gig, even if it's a specified service industry, and you have a $50,000 profit. And again, looking at your whole income, if that's your only income, then you're looking at a 20% QBI deduction called QBID, and you're going to get a $10,000 deduction against income tax. You're still going to pay self-employment tax. Now, if it gets higher, that's when the issues come into play. And that's where those specified service industries come in. Now, let me show you one more thing here I really want to get into. This is going to be the corporations. And so maybe you have a side gig that's an S Corp. Maybe you invested in the stock market, you got a REIT. Or maybe you have master limited partnerships, things like that. You're going to end up, and I'm going to try to pull one more thing up here for you guys. I want you guys to see this. This is, and nobody lost sound, did they? So I'm changing screens. This is a draft that's not in existence yet. This is what it's going to probably look like. As you can see here, August 20th, they gave us this draft. It's not done yet. However, we know that the S Corp K1s, and they're going to look a slight bit different for partnerships. But if you notice in this bottom right-hand corner, box 17, that's going to be box 20 for the partnerships. And if you look at the instructions, they're going to have a bunch of things, a little bit hard to read here, that are going to say, like line, code W is 1099A, W-2 wages, things like that. If the preparer of the return of the business does not click the right boxes, nothing will show up in box 17 or box 20 for partnerships. If nothing shows up there, it is deemed to be zero by the IRS, and you will have no QBI deduction. So if you see if you're doing your own return and you see box 17 or on a partnership box 20 and there's nothing in there, you need to get serious and talk to the person that issued that to make sure they get that fixed, because otherwise you get nothing. Now that you see that there, let's take a look at our tax return again. When you're doing a K1, it looks, again, my screen is going to look a little bit like this. They're going to look very similar on the over-the-counters. They're going to look like the TurboTaxes. If you use 1040.com and use the link through my blog, then one, you make me very happy because that's an affiliate. It's also my software. And it's going to look very similar to what I'm showing here because it's a professional grade software basically being licensed out to people doing their own return. But when you go to screen 2, you're going to notice some new stuff this year. If you're familiar doing your own return, bottom right-hand corner, that QBI, again, qualified business income deduction. Box 17 here, at least on my screen, is not going to have all those QBI deductions listed on this screen. So you can't just plug and go. There's going to be so many, and you can't put them on these additional screens here where you get all this really weird stuff going on. We're really going to be sitting here, and on this lower right-hand corner, if you can see my mouse, you're going to see the code VWX, and that is extremely important. You want to see those numbers on that K1. If you have a REIT, so people have been buying REITs saying, hey, do I get this kind of tax advantage? Do I got to pay tax on all my gains on my REIT? And the answer is no. But you better make sure that they have that K1 coming out showing the box 17 Y and Z, telling you what the dividends are and any of this qualified income. If you look at a partnership, and by the way, estates get this too, but we won't go that direction. Partnerships, as you can see, it's just box 20. So what I'm going to do with this QBI stuff is I don't want to spend a whole lot of time just pounding away at it. It can be just overwhelming taking classes on this stuff. I want you to have the basics, and the tax preparation part, I think, will be fairly straightforward with most of the software because it works fairly clean, at least what I'm seeing here. I think the real problem you're going to have is when you have to deal with tax planning. So it's not the end of the year. You got a couple weeks here yet, guys. So you want to go, and when I have the link at the end of this, you want to actually take a look at this website, and you want to start looking at some of your numbers, and you want to go out and start running your numbers in your side gig, in your small business, and you want to start putting this information together. In other words, what I'm saying is, I know the year's not done, but you have a pretty good idea where you're going to be. For example, things like putting money into a retirement account can make a big difference here, is what I'm saying. How much you pay yourself in your business can make a difference, depending where you are in the scale. So I don't know if you guys have specific questions on this. It's not always as clean as I would like it to be, but this QBI thing is going to be a lot of questions this year. I've been calculating some of these on the side for clients and doing some planning, but boy, it just takes time. And this program online is kind of nice here. So let's do this. Oops, that's my Facebook page. And let's go like this. There we go. So actually, let's do this. I want to go back to my screen. So that is QBI in a nutshell. If somebody has some questions on that, then I would like to look at one more thing before we kind of open the floor here. And that is charitable strategies, how to save money with charity. And by the way, I've run across this too. I actually have a guy that's going to be able to take $1 million deduction this year because we're getting this done before the end of the year. Very high income individual, but he's going to be putting away a lot of money into this. Now, the problem everybody's going to have today is that if you have, in the past, you may have itemized. So let's do it this way. So I'm going to go with marrieds because it's an easier number for me. I'm married, filing a joint return. If you're single, you get $12,000 for a standard deduction. Head of household's 18, I get $24,000. Well, for me to itemize, it was pretty hard because I had a very low mortgage for a while. Now I have no mortgage at all. I have a few things going on in my Schedule A that might help, but I can only take what's called SALT taxes of $10,000. So my state taxes for income taxes for Wisconsin, as well as my property taxes, capped at $10,000 per year. After that, it doesn't do me any good. Well, if I don't have any mortgage interest, what's left? Okay, I have medical expenses, but you need a lot of them to count. So that doesn't matter. Deductions subject to 2% of adjusted gross income are gone. You can take gambling losses if you have gambling winnings. Well, I don't gamble, so that's not there. So you got two things, really. You got $10,000 maximum for your state taxes, and then you have your charitable contributions. Well, my goal is to double dip whenever I can. I'm going to get $24,000 right out of the gate, no matter what I do. That's just a gimme. Now, excuse me. So what I can do is I can shift gifting from Schedule A and still get my $24,000 and get it to a business return. And here's the difference. So, and I want to make sure I'm clear with this, because when I say this, some people come back and they don't change anything and they just retitle it and they think that gives them a deduction. If you are tithing, if you are giving money to church, throwing money in the plate on Sunday, that is going to go on Schedule A. I don't care what you do. It's just the way it is. But now a guy comes up to me and says, my church is doing this wing, or they're supporting this program. It's maybe a homeless shelter, and they're raising a lot of money. You can sponsor that wing. You can sponsor a hole in a golf outing. I do that a lot for Children's Hospital. Those are not charitable contributions, even though the money goes to a charity. It is actually a sponsorship or a promotional expense for your side gig. This even works for rentals. If you have a half dozen rentals in town and you say that you call it XYZ, well, let's say you're in Tupelo, okay? Tupelo Rentals LLC, okay? So you might want to do something good for the community. So you want to donate, let's say, $2,000. So every year they have a thing in the Fox cities here where I'm located over the 4th of July, which is kind of like, it's like a 4th of July event. And they have a whole bunch of stuff going on. They raise money from businesses. I give money to that pretty much every year, and I sponsor it. They put my name up on a pole saying, hey, this guy sponsored. And of course, Tax Prep and Accounting Services is up there. That is not a charitable contribution, though it is a charity I'm giving to. It is sponsorship, which is a deductible advertising expense for my business. If it is reasonable, then the answer becomes very clear that that is an acceptable expense. So if I have rentals and I decide to have a couple $1,000s, that's reasonable. If you have 5 or 6 rentals and you want to put $50,000 in, that might be a little more problematic. But you can certainly deduct a lot more things and double dip by doing that. If you have a side gig, if you have a small business, whenever you want to give money to a charity, even if it's to your church, they might say, well, we're going to do a sponsor. We need a sponsorship for some event. don't give in the plate on Sunday. Let the plate go by, and you might feel a little embarrassed. Don't worry about it, because you're going to give your money in a different way. You're going to accomplish better goals, and you're going to get a bigger tax break. So if you're kind of like me, where you're a little more philanthropic in your thinking, this allows you to save more taxes, which means you can give more money to causes. So I like to give to things like homeless shelters. I like to give to things like, now in my community, I noticed that there is a warming shelter, because it's been a pretty cold winter so far. And I'm looking at ways I can maybe fund that through my blog, actually, so the Wealthy Accountant blog will say, if you do this, I'll give $1,000, and then everybody that matches it, I'll give up to $1,000, and I might do that each month for the whole winter. Now, that is a promotional expense. That is not just a contribution. That is me getting press time. It's bringing people to my blog. It creates goodwill. That is no longer a Schedule A charitable contribution. That is a promotional expense for my business. And I want you to start thinking that way as well. So those are the topics I wanted to cover briefly. In the stuff in the beginning here, let me see if I have, because my screen, I have two screens, but there's a lot of things I got to have on the screen. Okay, I'm going way back to the beginning. It says, Keith, Keith, so under 50,000, no real option. I'm not sure what I was talking about then, and I think my audio started kicking out on me. So we're going to go back to some of that. I hope I say this right, Clau. I hope I say that correctly, if you're still on. Could you, if you want to rephrase that for me, or let me know? The thing is, I was talking about QBI in the beginning. What was I talking? Oh, I see. I was talking LLCs at that time. Okay. If you're under $50,000, it's not wrong to have an LLC and have a side gig treated as an S corporation. But it will not necessarily do you much good from a tax standpoint. So I love the idea of an LLC. If you have rental properties, even a side gig, in most states, and I'm gonna give you a little trick here to keep this cheap, by the way, in a second. In most states, it's not real expensive to have yourself an LLC. You don't have to do anything with it. Just put your business in the LLC. Okay, so XYZ company, I have this LLC, and that gives you the liability protection. That's what it's built for. It's not a tax tool, it's a legal tool. So we set these things up all the time because we want these wrappers around all the stuff that we're doing so that we don't lose our personal property. We do not lose or risk our personal wealth because of a side gig, something, you're doing something on the side, making $10,000 or $20,000 or $30,000, and all of a sudden you get sued for $1 million. You don't want to lose your house and everything else with it. So we want the structure in place. But the LLC then can be, it doesn't have a form. It just defaults to a sole proprietorship. We can now turn that into something more valuable once your income goes up. Because once your income hits about $50,000, you start squeaking really loud, because first I tell you the income tax, and you go, oh, the income tax ain't too bad. I can handle that. Well, but when I say we got to add another $7,500 of self-employment tax, and now you get a little bit cranky on that. And I don't blame you. So that's when we want to actually start looking at an S corporation, because we want to save some self-employment tax issues. And that's why under $50,000 is not that you can't do it, it's generally you don't want to do it. The LLC is a great idea, but I don't need extra work, and I don't necessarily need the extra work. So unless my client gets good advantages from this, I don't want to be doing it. Okay, I just don't want to be going to an S corp until you actually, it's all that. I want you saving so much money, it covers all my fees, and you get an extra $1,000 or so for yourself. That's my floor. You got to have at least a couple $1,000s for your time of having an S corp, and then I'm happy to turn you into one. Get an LLC, you got to pay a lot of money to keep them. Every year you got to renew them. And what people don't understand is you don't have to have an LLC in your state. So let's get rid of this here because we're not talking about that. So an LLC, I set up LLCs for people all the time in Wisconsin because they're fairly cheap to set up, and it costs like $25 a year, and they have a $1 fee on that, so $26. But what you need is if you want to file in the state of Wisconsin, you have to have what's called a registered agent. Every state has this. If you file in your own state, you can be your own registered agent. Well, if you're in California, or if you're in Texas, where these rates are really, really high, I charge $109 in my office currently for registered agent services, and that includes the $26 that goes to Wisconsin. So you can have an LLC set up in Wisconsin. I can be the registered agent, and it's cheaper than setting this up in some of the states that have really, really high fees. When it's only $100 or so, or if you're in Wisconsin, it's $26. You can then have more of these LLCs to protect more of your properties separately. Specifically for, some people, they rent out their home. You may wish to put your home in an LLC. So some people are doing the Airbnb thing. If you have a cabin, up northern Wisconsin or wherever you're at. Okay, 1 second. No qualified deferred compensation plans. Thoughts on this from the Fox Cities as well? Excellent, Eric. If I say something wrong, don't throw a rock toward my window. That would be nice. Eric knows how cold it is here, so we have some interesting weather today, actually, as I'm doing this. Non-qualified deferred compensation plan. I'm wondering where you're going with this. So you're talking kind of like the non-deductible withholding, like an in-service type plan. I mean, you can use non-qualified deferred compensation plans, but if the income's really low, I would probably look in the direction of a Roth IRA first, because again, it's a qualified plan, but I can take the money out a lot easier. I get some tax-free benefits. Whereas if it's a non-qualified, which you have as a basis, you're going to have to be tracking all the time. There are non-qualified plans. Usually with the non-qualifieds, people will say, well, I'm going to do this solo 401k with my side gig. And okay, so you're doing this profit sharing plan, and again, let's go to an S corp. It's kind of easy to see this that way. So you have an S corporation, and let's say you make $100,000, and you come in and you say, okay, I want limits my wife's 401k limits due to being a high wage earner. Okay, let me do this. I've been using this a little bit. Actually, I have some things beside my desk here. I'm going to show you, Eric. And this is something to really go out there and let's hypercharge some of your savings. So you're being limited based on a high wage because of your AGI. So let's do this. You can take $18,500 with a 401k, and then matching whatever the company has. If you're working for your own or for somebody else's company, they might match 3, 4, 5%. But now you have a problem. And because you have a side gig, you're going to be limited by how much you can be putting into a Roth IRA or any kind of IRA. Depending, you might be able to do a spousal, but that might also be phased out. If you have your own business, you can certainly do something. If you have a small business, a side gig, and it's doing $20,000, $30,000 on the side, and you want to put some money into a retirement account, I would argue the best choice there might be a simple plan. It allows you to put $13,500 in per year. Even as a sole proprietorship, you can do this up. It's $13,500 max per year, or what you earn, whichever's less. That would be a way to get some money into something tax deferred. I don't know if I'd want to put as much into a non-qualified. If your wife's income is really, really high, you're in a higher tax bracket. So I just want to get money out of my I want to get money out of my taxable account, my taxable income. And the way to do that, I think, for a side gig would be, I think that the best way to do that would be some kind of simple plan. If it gets a little bit bigger, then you might want to do something where you can set something up like a solo 401k. And if you go through someplace like ADP, and I got a contact for this if you want to do this, you need a 401k plan that does what's called in-service transfers. An in-service transfer means that you can take the $18,500, withhold it from your paycheck. Since it's your own business, pretty easy to do. You set this up, and then you can do some matching. The profit sharing can go up to 25% of your wage. But you have this $54,000 ultimate ceiling way up on top. So I'm just going to I need a calculator because I'm an accountant. So let's say we have the $18,500, and you withhold it from your paycheck. And let's say another $2,500 is matching. So you have $21,000, but you really want to put in the full $54,000. So you have another $33,000 difference in there between the ultimate cap and the cap that's being enforced upon you because of your personal contribution and the matching. You can take a non-deductible deduction from your paycheck up to that $33,000 limit. And then if there is an in-service transfer option available with your 401k plan, and Fidelity does not, I'm pretty sure, because I've run across this recently as well, but ADP generally does. I've had some people doing this with ADP, I'm certain of that, and I got a contact guide for you if you need that. You can just contact my office or use the blog and just send me a note and I can forward that. But you can then in-service transfer that to a Roth IRA anywhere you want, and let's say a Vanguard Roth IRA. This is what you would have when you see it's not the mad scientist does this, Brandon. He has the mega backdoor Roth is what he's talking about here. And I'm not sure if that's the direction you're looking at here, but hopefully that answers the question, gives you a couple of ideas to maybe hypercharge some tax savings there for you. So those are the things that I have. I also, in my book here, I have, boy, I tell you, there's some other issues. These are kind of personal issues. I don't want to go off on the things that might not make a difference to you. There's a link here. This is something that a lot of you guys won't have, but the University of Pennsylvania, the Wharton Business School did a huge study where they predicted that there would be a mass exodus, a mass conversion from pass-through entities such as S corporations and partnerships to C corporations based upon the tax law change. It really, I've looked at those numbers and at this report. This report was done earlier this year. I don't think, excuse me, actually it was put together late last year when the law was coming down as it was being reviewed. I don't think that analysis is actually correct. I've been doing this for a lot of clients, and I don't think we're going to, I think the S Corp is still going to be the king for most people. If you have a side gig, you're either going to be a sole proprietorship or an LLC as a disregarded. And the second thing you're going to do is you're probably, a C corporation still is very hard to work unless the numbers are really high. And I have a client that's making well into the 7 figures that I'm switching back to an S corp because it's going to be worthwhile. Angela says, I'm a California resident who will be doing business in Texas, Arkansas, Oklahoma. Can I create an LLC in Wisconsin or another state and save on fees? Absolutely. In fact, my California clients, when people come to me and they say, excuse me, they'll come up to me and they say, geez, Keith, let me just kind of put this down here so that you'll just get my back screen here. I'm going to show you a little trick. This is really, get rid of this thing. Come on. This is a really neat little trick. And I don't want my sound to go out, so I am just going to kind of blank out my screen here. You'll get to see all my icons and that, but it's all tax stuff, so don't get too excited. You can be an LLC in any state you want. It's very common for people that if you have a high-risk business, you're going to pay a registered agent in Delaware, most likely, because Delaware laws are very, very advantageous for businesses. So when I had 2 hedge funds many years ago, I organized both of them in Delaware. And those were Delaware LLCs, and I had a registered agent over there, and I coughed up a huge hairball. But it was a very, very litigious hedge fund industry I went into. So what I did is we filed probably 30,000 lawsuits in a year because it was basically we were helping banks. Basically, we'd buy off their bad debt, then we'd turn around and we'd try to collect on this and clean it up. And we were cleaning up pretty bad messes. As you can understand, I got out of that business because it's a pain. Being in California, you know what I'm talking about. This can be an extraordinarily painful thing. The only issue with California is that it depends what industry you're in. If you're in some of the medical industries, you might have to be in California. So if you're doing this business in multiple states, including rental properties, you can have an LLC in any state, including Wisconsin. And what I do is this: I think the legal fees, what I do is we use the legal forms for Wisconsin because it is Wisconsin, and the fees together end up being $785, which is pretty cheap compared to California. And then every year after that, it's $109, which includes all the state fees in each case. We keep track of that here. We get a little blue card in the mail every year. When we get it, we then send you an email. Do you still want us to do this? If you say yes, I go online, fill everything out, then just tell them you want to keep the thing. I pay the $26. And then you owe me $109. And then you have to ask the question, what do I get paid for in that? Well, what a registered agent's job is this. Excuse me. The registered agent is supposed to be the one that takes legal process service for you. So a couple stories I can add in here. The process, the registered agent has to have nexus in the state that you're going to be an LLC in. In other words, they have to have a physical presence. So here, my business has a physical presence in Wisconsin. I can be your registered agent. Should this business ever get sued, the attorneys ought to be looking up the registered agent. They can send it to you personally, but if you don't get it, you could end up going to court, not even knowing it, and losing just by default. If you have a registered agent, what happens is they're going to serve the registered agent. And the registered agent, someone like me, is going to be on the phone a lot until we get a hold of you. We're going to be yelling, screaming, emailing, texting, certifieds, everything to get a hold of you because we have legal documents in our hands that you need to have. So a registered agent actually does something. Most of the time, there's nothing done at all. But every once in a while, the process server comes in. He's got a foot of paper. And it might be for, sometimes if a business is in trouble, sometimes there's a bankruptcy. I get those here as well. But very easy to do an LLC in another state. You get that legal wrapper. The only difference is that you follow state law in the state that you organize in. In most cases, unless it's a highly litigious issue, in which case you'd probably go to Delaware and you'd want an attorney to look at this in your state then. If you want some anonymity, then there is some of that with Nevada LLCs. But all the companies in Nevada know that, and it's a kind of a big industry over there. Excuse me. So what they do is they get kind of expensive on you over there. Nevada makes a lot of money, so their residents don't have to pay tax. So hopefully that answers your question, Angela. If you have rental properties, or if you're doing some kind of side gig, or if you're doing rentals in different states, if you have rentals in 3 or 4 different states, you may wish to have more than one LLC depending on how many. So if you have 3 rentals and they're in 3 states, Texas, Arkansas, and Oklahoma, I would argue that you would put all 3 in one LLC. If you have 2 or 3 in Texas, 2 or 3 in Arkansas, another 7 in Oklahoma, then we might want to have a couple of different LLCs. Keep in mind, if you don't do business in a state, you don't have to file a tax return there. So if you have an LLC set up in Wisconsin, but you're doing business in Texas, no state income tax, don't worry about it. Arkansas, you still have to do an Arkansas return. Oklahoma, you're doing business there, must do a tax return there. And in Wisconsin, you're not doing business. No tax return required. You just have an LLC here. And of course, you're a California resident, so the tax you pay in the other states is a credit, but then you pay tax at the higher California rate. And I say that without any tongue in cheek because California has a pretty high rate. So we are in about an hour now. I blocked out 2 hours, and I apologize for that in the beginning, some of the audio. I will address some of that in the next one. Next week, Tuesday, I'm going to be dealing with more personal issues on personal tax returns versus businesses and rentals. But this is such a big issue. I'll try to figure out what the screensavers are for me here. And if you have any additional questions, I'd be happy to answer them. If you have some personal questions that you don't want me or don't want the world to see, I fully understand that. What I would do is I would go to the blog and I would just send me a contact. Keep in mind, I am really, really far behind right now. Oh, here's more coming through. I'm sorry. Like I said, these screens with multiple screens, there's a lot. So, Carlene, my primary income comes from 3 single-family rental properties. I have no W-2 or 1099 income. I purchased my health insurance off the exchange. If I put these properties in an LLC, can I pay my health insurance as a business expense? Also, can I somehow take advantage of the SEP? Excuse me. The health insurance premiums Okay, you bring up a really good question here. You got 3 rental properties. You're welcome, Angela. Thank for the thank you, she said. Carlene, this is you bring up a big question and something again that normally I would have said, can you deduct this above the line, so to speak? In other words, you would deduct it as an adjustment to income. That's normally what it would be. But now we brought up this topic with the QBA, with the QBI, the 199A deduction. Well, we got some serious issues all of a sudden. If it's a trade or business, shouldn't that be on the front page of 1040? And I'm going to take and let's go ahead and I want to take a look at. No, I don't want to look at. I want to do something different here. The answer normally is going to be no. But I think there might be a better answer here. Yeah, they're working just on self-employed. They don't care if it's a trade or business. So for rental properties, no 1099s, no W-2. You purchase it off the exchange. Well, here's the neat thing. If you purchase it off the exchange, you might get the premium tax credit. That is still okay. If you put the properties into an LLC, can you pay your health insurance through that way? That's a no. Also, can I, because you're going to have to put that in Schedule A, and I agree, that is problematic. I'm trying to think if there's a solution around this. Also, can I take advantage of a SEP IRA? Not with rental income. Even if you put it into a partnership, even if you put it into an S corporation, this is, even though I understand you work at this, you could be an active participant, but it's still considered a passive activity. And you have to have you have to have a non-passive activity. You have to have what's called earned income to be able to put money into a SEP. So unfortunately, the LLCs would provide a legal umbrella. What you could do, and now this is me just thinking out loud. So this is just kind of like a consulting session where I'm trying to come up with a solution. I wonder if you paid yourself as a Schedule C for management, and if you do some of your own repairs and maintenance, and you 1099 yourself from, because your LLCs, whether you have an LLC or not, your rentals are probably going to have their own EIN number because you don't want to be giving that out to anybody, your social to anybody. So you want to get an EIN. Your EIN is going to cover all the LLCs if they're disregarded. So you only need one. And your LLC and your EIN is going to cover all your rental properties no matter what on your personal return. In fact, you only get one EIN per person. The only way to get another EIN is to actually have an S corporation of some sort, because your LLC as an S corporation is going to need an EIN. Your personal tax return is going to have one EIN, and it's going to cover everything. So if you have a farm, some rentals, and a small business, all combined together. So what you might want to consider is that your rentals pay you for some management fees. That would allow you some deduction. I would argue, I mean, this is stretching it a little bit. I'm not saying that you should do this. I'm saying this is certainly a possibility. If somebody, let's put it this way, if somebody comes to me and they have a whole bunch of properties, it's very common for them to strip this kind of thing out. If you had somebody in it as a partner and you're doing the management, of course you would do it. So, and a partnership is nothing more than a sole proprietorship with more than one person. So if it works for a partnership, why wouldn't it work for a Schedule C type situation or Schedule E? So I wonder if you could go ahead and do that. So let's say you have X amount of dollars of income, and you say, well, if I hired a property manager to do this, then I would pay X amount of dollars for doing this. So I'm going to pay myself that instead. That's going to go on Schedule C. Now you can go on front page of 1040. Now keep in mind, your health insurance premiums are not deductible on the business return. They're going to be deductible on front page of 1040. And in fact, I think they turned that into a schedule now. I forget. This is probably going to go, my screen is going to look like previous tax returns, but you're going to end up with like a schedule or schedule 1, 2, 3, and 4. There's going to be all these really crazy schedules in there. Yeah. That's where it's going to end up going. I'm not sure how the other tax programs will do it, but that's an adjustment to income. So what's going to happen is you would have money from Schedule E going up here into Schedule C. You would maybe have a few minor expenses. You would not deduct your health care here. My program kind of makes it nice. It usually put it in here. This year might be different now. They'll make me a liar. Actually, I think they, here we go. So right here, if you see on this side, it's going to say my, what's called the SE high screen for its health insurance screen. You can plug numbers in there. In my program, I can put it right in here and it will carry and do all the work for me. It will not end up on the business return. It ends up front page of 1040, but that's certainly a lot better than Schedule A, which is probably worth nothing. So, and let's see if anything else has snuck through here for me. I think we have everything in here. I'm going to add a couple of links to the bottom of this thing for you guys. And if there's any other questions, Carlene and Drew is here. Hey, all right. So thanks for putting these on. Since you're already talking about rentals, can you tell? Yes, that's where I probably phased out a little bit. I'm going to redo this because I know Drew's going to want to do this. You're welcome, Carlene. Drew is, by the way, a tax professional down in Milwaukee. I've sent him a few clients, and he's I don't know how many more he can take, but I have a lot of people I have to take a pass on. In my office, on the left-hand side of the screen, my office is going to have a policy for rental property. So the IRS has been extraordinarily silent on what it means to be a trade or business when it comes to rental properties. So guys have these rental properties over here. We have to, on the bottom right-hand screen, we have this thing that says activity is a trade or business, yes or no. That is going to make a difference if we do the QBI deduction, and there's a long formula for that. And by the way, for Drew as well, I'm going to be adding a link here. I'm going to show you. This is where you can actually online where you can calculate QBI for your clients and kind of figure out where they're at before the rules come to an end. At the end of the year, you're kind of done. I'll get to you in 1 second, Eric. So this screen is going to be kind of nice. I'll put the link in the bottom, Drew, in a second. But when it comes to rental properties here, let's see if I can get back to my tax return. Oh, here we go, tax return. When I was at Tax Insight, I got probably the best answer I've ever received for what a trade or business is as it applies to QBI and rental properties. And that is this. They thought about it, their whole round table kind of came up with a solution that if you're doing the tax return to Schedule E, and when you sell the asset, if it goes on Form 4797, sale of business asset, then it is a trade or business. If it ends up going to Schedule D, then it's really going to be kind of a business, and therefore it would be not a trade or business. And as Drew knows, and the rest of you may not know, trade or business is not defined in the tax code, so we have to actually go to the tax court to find a definition of what trade or business means for tax purposes. Now, let's break this down. So if you have one rental, and that's been the argument, the tax code says the provision 11011 and HR 1 is the replacement that goes into section 199, which is 199A now. What it does is it says the word apartments, plural, with the S. Well, some people have argued, some classes I've taken have argued, if you have one, it doesn't count. Well, then the argument comes up, well, grandma and grandpa own their house. They decide to rent. They decide to move into a place down in Florida, so they're going to rent their property out, their personal residence out. Goes on Schedule A, or excuse me, on Schedule E. Is that a trade or business? And my argument is once you do that, the answer is yes, it's a trade or business. You're getting all this money, and it's going to be a trade or business. But what about the guy that has a property up north? They bought a cottage up north, maybe some hunting land up north, maybe a second home up north. It's personal property, but they rent it out every so often. I would argue that when those get sold, their investments, they go straight to Schedule D. If it's a loss, you can't take a loss on personal assets, but on gains, you'd have to put it there. That gives me the indication of what a trade or business is. And it'll be great. Tax pressure software has a similar feature, but I love it. Okay. Yeah, I'm still working with my tax software, Drew, as well. I'm playing with some of the details in there. There are some tools, but I wanted tools that everybody could use that weren't tax professionals. So that comes from, I think, Illinois tax. It's an accredited this right here, Tax School of Illinois, University of Illinois Tax School. So I think anybody can use that. If you're doing your own taxes, you probably want to have a policy, which is what my policy in my office is going to be. The rule is going to be straightforward and simple, and that is if it gets sold, it's going to 4797 as a trade or business. If it would go to Schedule D, then it is not a trade or business, and that is much more clearly defined in my mind as a demarcation line. And I think that that's pretty important, that you have consistency if you're in an office. Drew, if you have a different answer, if you're going to be using a different policy in your office, I'd be curious. I know where I'm going with it, and until somebody gives me a better answer, that's my answer. I'm sticking to it. So that's it. We got about 1 hour and 15 minutes in here. And again, I would answer more questions if you want, because I didn't block out 2 hours. But I have been playing with this new technology. I had a free program that I used called Be Live, and then I paid like $240 for a year, and they gave me all the bells and whistles. Well, as soon as I tried to play at the bells and whistles, the thing collapsed. I had to download a Chrome extension, and then we lost my audio in the beginning, so that's not good. But that's so that's kind of where we're at there. It should improve. I'm just a backwoods accountant, so you got to forgive me, but I will get better. I'm much better now. So, and you're welcome, Drew. If anybody else has any other questions, otherwise I'm going to close this out. It'll be available. Hopefully, I'll put a note in that as well that people skip some of those marks. I think there's good information, but the audio is a real problem. Next week, Tuesday, on the 18th at 8 o'clock Central Standard Time. Excuse me. We're going to be covering deductions people miss, ways to get that AGI lower, so things like the healthcare.gov things can be maximized, including things like if you have earned income credit or something like that. Dealing with the property tax issues. If you're in a high property tax state, I got some ideas here, and I'm surprised so many people don't have it. Drew, being an accountant, he's going to be very well versed in some of this, but we're going to talk about some things you can do to make those unreimbursed employee business expenses deductible legally. We'll talk a little bit about asset allocation for real estate investors, and then capital gains taxes with opportunity funds. That is a huge opportunity, pun intended, I guess, to not have to pay taxes anymore when it comes to self-employment tax. Oh, and Emily says she enjoyed it without even having a question. I hope I keep it upbeat enough. It's one of them things that taxes, unfortunately, if you don't have a lot of coffee with you, there you go. If you don't have a lot of coffee, sometimes it can get dry. I try to keep it upbeat and a little more tempo, because if it doesn't help you, Emily, what I've told you here, or even having a question, it sometimes can jog something loose in your mind. I don't necessarily get into your mind, but it might be something totally unrelated that I jog loose in your mind. And if it saves you money, that makes your life better. That means you can do things in your own community that make it better. And that's why I do this stuff. That's what gets me excited, because taxes are going to be here with us forever. It's just the way life is. But if I can make it better for you and your family, help you reach personal finance goals, if I can help you reach that early retirement or financial independence, whatever your goals are, that's what I'm doing. So Drew says my policy makes perfect sense. It'll be up to him how his office does that. I'm not going to tell you what I recommend or what you must do or should do, but I think my policy in my office, if you're a do-it-yourselfer, this is certainly a way to go. So if there's nobody else, I will be signing out. If you type quick, not 5, 4, 3, 2, and we are done, I think. You guys have a great one. I am very glad you came. Thank you very much. I enjoyed this. I hope you got some value out of it as well. Have a good day.